Alright guys, welcome back to another video. I don't script my videos, so I'm basically just letting my thoughts off rip, and you can basically just see and hear, obviously, what it is that I think about the markets. And that's basically it. I don't really like commenting on charts that have already printed. I don't really like commenting in hindsight, which is why I make these videos, because it's a live chart. You can see the new weekly candle just opened. It is 5:16. So market just opened and we are live. Now, first off, I want to recap the last video I made about the majors on Forex. And if you recall, or if you don't recall, hopefully my memory helps me and I remember to tag it in the YouTube video, and I'll put it in the top right corner. But if you recall, I talked about a bearish bias and a bearish bias for the euro into the midpoint of this wick, which had a PD array on the daily time frame right here, denoted by this balanced price range. And I noted that level as a PD array and a key level for price to react from. Now, I made that video all the way up here. I made it on the night of the 21st of September, Monday or Sunday. In New York time, it's Sunday, but technically it's Monday. And I made it on this bar right here. Now you can see how accurate that was, right? This was something that I made over a month ago, and it was made in September, the bearish bias. The video is still up. You can go watch it and understand my entire logic as to why I was bearish. I won't be talking about that today. That's just a quick recap. What I want to talk about now is moving forward. What's the update? What do I think about the markets? And that's the topic for today. Majors, right? Again, it's not a it's not a mentorship. It's not a lesson. It's basically my thoughts. And yeah, I like to put my thoughts out there. So let's get it. Now, we go back. I love the 3-month chart. I really, really love it. Really truthful. A 3-month chart would never, ever lie to you. You don't see all those fake outs, all that bullshit that's on the 1-minute chart. That doesn't happen on a 3-month chart. The 3-month chart is truthful. It will never lie to you. So, looking at all three assets, we have the XY, the pound, and the euro. Now, observing all three of these after we had that bearish bias from this level, where are we? First thing, the reason you go to higher time frames is to determine higher time frame ranges, determine if we are in premium. If smart money is looking to offset their positions, if it is too much in the premium, they're looking to sell, they're looking to give away and accumulate something else. There's always an exchange. Whenever something's being sold off, somebody got to buy it. You feel me? So we have this swing high that was formed. Remember, this is a 3-month chart, so every candle is key. Formed off of buy side. On the lower time frame, it's more evident. That was an equal high, right? And we had S&T with the pound, right? And it was a whole thing I talked about in the previous video. Now the euro, I expected it to continue higher from the wick of this candle, right? Now that was an expectation 2 months ago. And my expectations, needless to say, have, undergone changes. And I go through this live with my community. It's less about right and wrong, and it's more about adaptability. You don't marry a bias. If you have a bias, the bias has an expiry date. You always think of biases in options. So if you think about the way options work, you have expiration dates. So an option must expire. You can't be bullish forever. You can't be bearish forever. You buy an option that has an expiry date. So it expires tomorrow, next week, next month, next year. Options have expiry dates. And that is the way you should take biases. If you're bullish, that bullish bias has to come to an end. So your job is to determine the conditions that would require that bullish bias of yours to come to an end, which is what I want to talk about today, because like I said, I expected the euro to be bullish, and those expectations have changed for a couple of reasons. Now, if we look at the XY over here, and we take the range of the XY right here, take that range using the Fibonacci tool. I have a preset for a discount premium, and you look at price. What was the most recent swing high before we made this most recent swing low? Simple market structure. I don't want to waste time on it. This is the most recent swing high. So we have this as a range. Right off the bat, with this alone, I can end this video right here. I can end this video right here. And I would have said what I want to say just by drawing this tool, right? But that wouldn't do the whole explanation part of the video any justice. So we have this range, right? Obviously, we are in discount. We are also in discount of the previous dealing range because technically we are in a consolidation because we have not expanded outside of this range. But again, it's a 3-month chart. So an consolidation on the higher time frames obviously would have, large moves and large swings on the lower time frames, which is where we trade. I'm not a swing trader. I don't really, care too much about the profile on the higher time frames because I'm an intraday trader. But, it does give insight. All right. So we are in discount of discount. That's bullish. Just based off of technicals, like I said, I can end this video right here. Talking about no SMT, none of that. The video could end right here. We are in discount of discount. I find it hard to be bullish. I find it hard to be bearish in such a scenario, right? Now, we traded above this candle's high, closed below it, which some would consider a change in set of delivery. Quite all right. They will not be wrong. But this change to the delivery does not dictate how far price would go into this order block, right? Price trading inside of this range, which is the order block. If I take this off, we don't need the drawing. And I put this in a box. Price could go anywhere inside of this box and still be valid as a change to the delivery. The only time the changes to the delivery is invalidated is if price trades above the external, the outside of that order block on this time frame. So yes, I'm still bearish on the dollar, long term, because this is a 3-month chart. So probably like 1, 2, 3, 4, 5, 3 months down the line, that's like 15 months. That's over a year. I'm not gonna wait for that to be like, oh, I'm waiting for a 2-year S&T. I'm not that patient. Anyway, looking at this, seeing that DXY could in fact make a deep retracement. The next step now is to find, okay, where are we looking to retrace? Because if you recall, IPDA, I'm going to type it out right here. We have always consolidation, right? Consolidation. We have an expansion. We have a retracement. We have a reversal. Now, you can't always predict exactly when these will start and end, but you can use markers to have a speculation to a certain degree of accuracy as to when, not just when, where also price would start to begin unfolding any one of these sequences, right? And the beginning is always a consolidation. Now, if price expanded in one direction, it's not always a reversal. Sometimes it could be a manipulation, right? And that would be confirmed probably down the line if the DXY, surprisingly becomes bullish and inverses this gap, which I would say is unlikely based on the information we have right now. But that's not what we're here to talk about. We want to talk about the scenario of a bullish retracement into this gap. We're not worried about what's going to happen next year. We're not worried about, what's going to happen when price gets to this order block. We just want to talk about the possibility of DXY making a deep retracement into this order block right here. Now, I'm going to take all of these off, right? So from the 3-month chart, I'm going to go lower. But before I go lower, take note of these fair value gaps on the 3-month chart. The euro is still trading inside of the range of the previous quarter. 3-month charts are quarters of a year. 3 months, 12 years, 4 quarters, do the math, right? 12 divided by 4, 3 times 4 is 12. Anyway, pound is traded into the gap. Dollar is also traded into the gap right here, right? So that would mean basically the pound is weaker than the euro, which is also something I talked about in the last video, right? So going down to the monthly chart, right here, you can see that we had a pin bar above an old high, which these are the equal highs I talked about. And we have a reversal sequence. Now, usually I like to measure the wick of a reversal candle, pin bars like this, and I like to extrapolate it. Hold on, I like to do this. I like to use the 2.5 level as an expansion exhaustion level for higher time frame candles. I don't do this on lower time frames because the wicks on lower time frames are usually substantially smaller, and they have no bearing as to, at least for the most part, as to where price might go. Now, with that, seeing as we are in premium, right? Pound is in premium, dollar is in premium. The pound is in premium, euro is in premium, and the dollar is in discount. Looking at this and framing it as a market maker buy model, this candle, if you want to view it in the lens of the way T trades, AM trades, and the MMXM, how they talk about it, C2. So this candle, this reversal candle that printed this low right here, could be viewed as the reversal candle, which usually contains a consolidation. You can see indecisive candles are consolidations most of the time, right? Inside of this candle, you will find a sharp movement below an old low, which makes it a reversal. But the fact that it is indecisive makes it a consolidation. So by the time price continues to expand, this will later become an original consolidation. As you can see, we had this upward move, downward move to cancel out this whole thing. So that's like consolidation. So this will, down the line, become an original consolidation, and price will return to these levels eventually. Whenever that happens, I don't know. Could be this time next year. Who knows, right? But this concept is fractal. You can view it on every front, any time frame, really. It's all about time. Can I wait that long to finally take a trade? Probably not, But looking at this as a market maker model, C2, C3, we had an expansion. This is C4. What are we expecting? IPDA, consolidation, C2, right? We had expansion from a previous cycle, expansion from this high, expansion lower, consolidation, reversal inside of that below this old low. We start to expand away from that reversal. We retrace, which is denoted by the wick of this candle using candle opening dynamics. When a candle opens lower, most likely that opening lower is a retracement for a fractal reversal and, for price to basically turn around and go in the opposite direction. open, high, low, close, open, low, high, close. When the candle opens lower, it's likely that that opening lower is a retracement into a PD array. It always retraces into something. If it's not retracing into discount, it's retracing into a discount PD array or a premium PD array that is inside of another dealing range discount. It's always retracing into something. And it's your job to figure that out, which is exactly what I want to do in this video. You want to figure out what PD array price, supposedly has retraced into and where it is likely to reach after it has retraced into that, that PD array. Now, the euro has also formed something of the same sort, right? You had these wicks overlapping. On the pound, however, we have a gap. So the pound and the dollar are the only ones with gaps. Like I said, the pound is weaker, and we've known this for a while now, right? And we were able to anticipate which one would be weaker by the offsets at the highs. You can see euro made the turtle soup, euro made the sweep, pound made the failure swing. So we already anticipated that pound was going to be weaker. Remember, this is the monthly chart. It's very, very accurate with these patterns. It's shockingly accurate. Anyway, pound formed a gap. The dollar also formed a gap. Euro did not. Euro is the strongest, meaning it's not as weak, and you would have more trouble shorting the euro than you would shorting the pound. It's that simple. Now, going even lower to the weekly chart, we can now see the wick in question that we talked about in the last video over 2 months ago. And we can see the shadow of that daily balance price range that overlaps the wick midpoint. I talked about all of this. It's on YouTube. I don't delete the videos. You can go watch it, see if you can learn some stuff from it too, right? So we retraced into this. At least that's what I thought. I thought we were retracing in here for an expansion higher. And I was looking to see the euro go even higher from that level. But I have been proven wrong by this previous week's candle. And I went through this whole thing live with my community inside of the week, last week, right? We did it all live. We talked about it. And, none of this stuff came by surprise, really. So we had this previous week now invalidate, to an extent, my bullish bias. And the reason I say invalidates it, this reaching, this candle right here, where did it reach into? Where exactly did this candle, where was it going to when it traded from this gap right here, when it traded higher? Where was it going? How would be more evidence and more clear if I go to the daily chart, because here is so many wicks. So on the daily chart, you can see the last point where I talked about the video, and this is where we are now, trading all the way down here inside of these quadrant levels. Excuse me. So where did price trade into? Well, there's a couple of things. First of all, you always want to identify the range. So where is the last dealing range? Where last did price, take out an old low and start to expand? This is one, right? This high and this low is a dealing range, right? This high, I won't classify as a dealing range because, frankly, it didn't do anything. This high, however, I would classify as a dealing range because it was a retracement into a PD array inside of its own dealing range, right? This low, this high, retracement into it, expansion out of it. That is a what? I don't even know if it's an intermediate term high or whatever. It definitely is a swing point, though. I don't really know the whole terminology thing, but it is a swing point, and it is a dealing range because it retraced into premium and expanded out of premium. So it formed a range, expanded again, formed a new range, price, retraced into deep premium with a block inside of premium, right? This is the PD array matrix right here in the flesh. Fair value gap, retracing into an order block, expanded lower again. What did it form? Right here, when price traded higher into this order block and traded down below, what did it form? What did price form when it did that? If you guessed not guessed, if if you thought inverse fair value gap, you were correct. And this was a very big bone of contention that I was looking at to see price. I wanted to see price. I really, really wanted to see price trade above this and continue higher, but we failed to do so. And if you look at other assets at this point in price, right here, you can see on DXY that we had equal lows on DXY, right? Almost equal lows on DXY. And they all failed to take this high. There was no turtle, so there was no SMT at that high. What there was, however, was, remember when I talked about strength? Pound is much, much weaker than the euro. And if you take the exact same dealing range, which is this high, remember when a retracement forms and it expands out of that retracement, it forms a new dealing range. And that right there, my friends, is a dealing range. So looking at this dealing range, we can now ascertain that price did in fact retrace into a premium array, which is this inverse fair value gap right here. As you can see, apart from this balanced price range or, inverse fair value gap, there's nothing else. There's no other gaps inside a premium, nothing else. It's all wicks, right? So this was the main bone of contention, and you can see price reach straight into it and expand out of it. And I talked about this on Twitter. I talked about it with my community that because of this, the dollar might go into a slight deflationary market where basically the dollar gets stronger. In layman terms, a slight deflationary market, the dollar basically gains a bit of strength and it starts to go up, and other markets that, trade in relation to the dollar would, be inversely correlated, right? So dollar, GBPUSD, the dollar being, the pound being measured against the dollar. If the dollar is more expensive, the pound is very likely to be cheaper. Correlation analysis, right? So they are inversely correlated, and we have determined that price did in fact retrace into a premium array. So since we have now ascertained that, we can now zoom in and narrow down our focus to just one thing, can nail down our focus and be like, okay, this is the exact thing that we want to focus on, right? This is the one thing that, okay, I know that I want my attention to be at, right? So I'm going to take this off. I don't like seeing too much. We know it's there. You don't need to have it on the chart, right? And we have these quadrants, and prices started to trade inside of these, inside of these ranges. You can see it consolidate, wicks on both sides, kind of like taking everybody out. No stone left unturned. Everybody's getting some. Everybody getting whooped, right? In these kind of situations, I like to wait for SMT, and I like to wait to see one side of the market taken. Now, considering the fact that we have established this high over here, it's going to be a quite long video, so you might have to sit, take grab a coffee, have some food or something. Anyway, considering the fact that we have established this high as a retracement, we now want to see price expand away from that high. How was it confirmed, and how did I confirm and have it settled in my mind that we were very unlikely to expand again? Because again, like I said, I was still very bullish until Wednesday. And I talked about this on Wednesday. I and my community, we had a bearish bias and we nailed beautiful short. Okay, I'm not just, this isn't me coming to talk about something in hindsight. You can go on. I don't delete any message. If you care, I don't really care if you care, but if you want to check it out, it's over there. It's a free community. I don't like calling it a free community because it kind of downplays the work I do there, right? But it is a free community. You don't have to pay me to be in the community. And we talked about this. Price reaching into this gap, forming it's not a pin bar because we did not take the high. We did not form S&T. But what did happen? The last opposing candle, we formed an order block, right? And I was looking at all this and I was, observing that, hey, we're not likely to expand Wednesday, because a lot of people, when they're so zoomed in and they're looking at price, especially pattern traders, they're going to be looking at price. And if I use the replay tool and I just pretend that candle has not existed yet, they look at this and they're like, oh, they want to see price go higher, right? That's pattern trading. They're not using logic. They're not, trying to understand microcycles. They're not trying to understand where is the market going to, where is it coming from, and where is it likely to go next. right? I think I just said the same thing twice. But like I said, retraced into this, established this as a retracement. We are now expanding away. Let's go back into real-time price action. None of that hindsight stuff over here. Now, we have a PD array right here. Now, this PD array it has been retraced into, but I will not call this a retracement just yet. Why? Because price isn't really expanding away from it, and it's still facing high resistance below these lows. So what do I expect? I expect a measure of price trading slightly against the current bearish narrative and then continuing lower. Very likely that we would revisit this fair value gap, reclaim it, whatever you call it. Very likely we would trade back into this fair value gap and then trade out again. Also, side note, a lot of people like fair value gaps, and fair value gaps are a great concept, but they lose their efficiency when you're just looking for any fair value gap, right? You don't just look for any fair value gap. This is the daily time frame. Fair value gaps in the daily time frame are really important. You can see the fair value gaps that do occur here. There's not a lot of fair value gaps in this chart. There's one here. There's an inverse fair value gap here. There's one here. There's one here. And you can see they all get respected. If you pair it with proper market cycle understanding, they all get respected. They are very useful if you know how to use them. But if you're going around the 1 minute chart, hanging around, just drawing every fair value, you're going to get slapped around. You will get your ass handed to you. But, we did close below this level. We have formed an order block off of this level. We have this stretch of bullish candles, which is also a change in the state of delivery right here. Let me make this a regular line, level minus order block, right? So these highs over here, zooming in here, these highs, this candle, reaching for the candle, this wick right here. ICT defines that as a immediate rebalance when price is trending lower and it is being very efficient. It would often trade below an old low, retrace in the opening hours of the market, most likely in the London session, and trade even lower. Trades like this are also very good because, you're trading into a previous, basically, if you want to use support and demand or whatever it is you use, you're trading into an old level of, accumulation. And we retrace into that, trade lower, immediate rebalance, right? And we trade out of this order block, right? Retrace into the order block right here. And we trade even lower. Now, at this point, I would like to check the pound to see if we had any disparity at these highs. And we don't. We've had consecutive higher lows, right? And these were in, we are now in the future, and now we can see that basically they're like lower highs. But before we traded down below, these were higher highs. It was like we were making these lows, and we got into like this kind of consolidation right here where price wasn't really going anywhere. But these highs stay below each other. They don't trade higher. So there's no S&T over here. And there isn't on the dollar either, right? It's all the lows are just staying where they are. So I currently, even though I am biased, even though my bias is bearish, I currently have no speculation on immediate price. What I would like to see, however, is to see price once again reject this level. It could do it in a couple of ways. It could, first of all, come down into the midpoint, right? Come down into the midpoint, trade higher, and kind of hang around this quadrant level. Or, like I said, it could just trade straight up and reclaim that gap right there, right? You always want to have scenarios where you would look at price and, you would say, okay, so this is happening. I want to do this. You don't want to just say, oh, I want to do this and I don't care what the market does. If the market has not given you reason to make such a declaration, you shouldn't be making such a declaration, right? So we have those ideas spelled out, right? Potential retracements, and we want to see an expansion out of those levels. Now we've talked about, the pattern, the fair value gaps, the, Fibonacci's, and a lot of people don't like that. Some people feel it's too surface. They feel, oh, you can't have an ad just drawing boxes in the chart. So this second part is for you. Going into the dollar chart, I mentioned something earlier that we're going to have, or that I speculated that we were likely to have a slight deflationary market on the dollar. Completely regardless of the fact that the dollar did in fact have a bad jobs report, that did not affect the fact that we do have a slight deflationary market. And when the US government shut down around here, right? US government shut down, and then we went into this like strong consolidation right here. Look at this strong rally, right? And like I said, I was bearish. I really wanted to see price continue lower from these levels. But I saw here that we weren't really going lower. We were hanging around, and then the last straw, we expanded lower and we started to come higher. The moment we closed above this candle, forming an order block, I wasn't so bearish anymore. And that was even before this happened, before we closed below. That was when I made the post about the slight deflationary market, where the dollar gains a bit of strength, stocks go lower, right? Euro dollar goes lower, Bitcoin goes lower. And this is how you approach markets, right? So all of that stuff didn't come as a surprise. And if you genuinely think in your heart of hearts that it's completely impossible to determine where the market is likely to go, well, you won't be able to determine where the market is likely to go. You simply won't be able to do it. If you truly think that you can't, you won't be able to do it. It's that simple. No one's going to force you to do it. No one says you have to do it, right? You could just, it's kind of fun, hanging around in uncertainty. It's kind of fun. Trust me. Anyway, ignorance is always bliss for the most part, right? Unless it's something that's going to take your life. So we have a couple of things that we can look at that are really interesting, like this wickless candle, right? Devil's mark. And the most important thing, I would say, the most important thing is the monthly dealing range that I talked about, discount and premium, being in discount of discount, right? Going back down to the daily chart, you can see right here that these lows that we formed are not just, any lows. These lows are not going to get visited for at least a month. At least I think so. Hopefully the US doesn't go to war with anybody. Because if they do, well, you know what happens when they go to war. All of this stuff, when they were threatening war with, Russia and all that kind of stuff. This is what happens. Gold reaches all-time highs of all-time highs. Dollar, trades lower. Intermarket relationships. Anyway, we have a couple of these levels that price is very likely to trade to, right? And like I said, enough of the ICT stuff, enough of that, that's bullshit. We don't want to hear that, right? Anyway, I want to talk about the COT data and the commitment of traders report on the dollar and how you can use that to basically, to a very high degree of accuracy, determine where the dollar is likely to reach for in the coming months. You can see the chart right now, right? You can see right now it's 549, right? What's the date? It's 23rd of November. Anyway, if I love this indicator, by the way. It is called commitment. I think it's there already. ICT commitment of traders by 2 degrees. You can get it. It's completely free. It's a great indicator, right? Very great. Now, if I pop that indicator over here, and you can see it's loading, and it's up. Looking at this, we have basically a report of the it's like a weighted report of the direction of smart money positions on a scale So it starts at 0. You have this baseline that is at 0, and this indicator basically, draws a premium discount level of the high and the low of either the past 6 months, the past 3 months, the main program. It has a couple settings, but you don't really need to tinker around with it. Like, it works pretty good right out of the box on the auto mode, right? So it shows the hedge program. So it shows basically if the people who have, the largest amount of money, the market makers, if they are offloading shorts, if they are accumulating longs, if they are, piling up shorts above a node high, you can pair it with market structure and be able to tell to a certain amount of certainty where the price is likely to go, right? And it only works over long term because this report is released only once a week. So it's not something that would be very effective on the lower time frames. And it's a lagging indicator. So sometimes it could show some kind of divergence where you can see the indicator showing that smart money is actually hedging positively, right? As you can see here. You can see price, it can show that smart money is hedging positively, but the asset is trading lower. That is a divergence. And like I said, it's a very lagging indicator because someone could see this and be like, oh, I want to buy the dollar, right? And you won't exactly be wrong, because if you bought it here, you'd technically be in profit. But, it's swing. It's not short term, like I said. So looking at this, looking at the CLT data, we can see the divergence. And we can see that smart money has been accumulating for a long time. They've been accumulating since here. You see, the thing about the people with these large amounts of money, most of the time, they're not even trading for profit. They're trading to offset risk. So if they have some investments in, let's say, the Japanese yen, and something happens with the Japanese yen, they want to, de-risk on the Japanese yen. Let's say there's war in Japan. They want to de-risk on the Japanese yen. And they do that by, converting their positions, be it options, be it, Forex position. They want to convert that and offset it into something else, which is where you get intermarket relationship. They don't just pull the money out of the market, right? I mean, if they do, they pull it into something. What currency are they pulling it into? I mean, you can't just have money. The money has to be in a currency. And the dollar is the most popular one. It's what everybody uses. So when they, if they're trying to de-risk and, basically convert their money into something else, the dollar is the, most likely candidate. Now, like I said, it's not a certain speculation yet, but it is my speculation, and I do want to see price continue higher. This is my bias. And again, it could change if the week, goes along and shows me something else. It definitely could change, right? But this is my bias, and I want to see the dollar trade higher. Now, you might be wondering why I eventually brought this COT data up. If we are in a retracement program, you want to note where smart money accumulation was at its lowest. So where where the large funds had the lowest amount of long hedge positions, and we were below the 0 line at, almost minus 20K, which is basically in units. It's like trillions of dollars we're talking about here. So if you want to note that place, this, this right here, this zone is the point in the market where basically it was at its lowest. Now, if I take a vertical line and mark out that point or those points in price where we were at the lowest, you would see it lines up with a certain, phase of price when price started to expand lower. Now, using this, I want to note exactly where this spike happened. Now, this spike is telling me something. This is where most of the hedging started. And if I bring this up in the full chart, basically, bring this up in the full chart, and I think it's like this. Yes, perfect. If I bring this up in the full chart, you can see that this basically is the biggest change. It's the biggest spurt compared to every other spurt that did occur, right? This is 6.7. This is, 6.8, and this was 10, right? So this was the point in price this week, the week of March, Friday, March, where they, smart money went from heavily short to almost moderate. And basically you can see there's like a, inverse fair value gap of some sort. It's kind of weird, but yeah. And this point in price is very important because it tells me where most of those orders are, where they were accumulated. And in market efficiency, which is the entire point of a market maker model, price always likes to return to those points. Price loves returning to those points. Original consolidations, as we call them. Price loves returning to those points in price where smart money changed what they were hedging, what direction they were hedging. Now, if we look at this time in price, we can now focus on this right here. We have this as the end of where they were heavily short. This is the end of where, smart money was heavily short. And I can now take this away. We have established that, that's, premium and discount. This right here, this whole thing right here, these up candles, especially the low of this box, is basically my target as to where the dollar would be retracing into. We also have a PD array inside of that, a volume gap, right? Let me change this from 7%, right? So we have a PD array, which is also in premium volume gap. We have these up close candles. Now, remember, these candles are not random. I just told you why I picked those candles. And the reason is because that is where smart money stopped being heavily short. They basically flipped. So that tells me that at this point in price and time, they pumped a lot of money in here. And if you're just looking at candles, I don't need to see the order book to know that for a fact that this would be a high volume node. I don't even know, does CBC have volume data? Let me check. Let me take this range. Yeah, so it doesn't have volume data. I'll check the futures one after, but I just want to buttress my point. This basically would be where I want to see price return to. Why? Because if we are in a buy program, that would mean that more longs are being accumulated here. And if the same people who bought here have positions at each and every one of these lows, obviously at some point they want all of them to be in profit. At least I hope so, right? And for the positions at this level to be in profit, or at least to get to break even so they don't lose on those hedge positions, which is the whole point of hedging, right? They would need for price to return to these levels, at which point they will now cover those longs. And when they do that covering, depending on how fast they do it, you would see a fast reaction, very, brutal reaction at these levels, right? If and when they do it, because they might not, you never know what happens in the future. Maybe they need to hold those positions and they choose not to offset, right? This is how you do market analysis. You don't just come into the chart and be like, oh, fair value gap, high, buy side, and then you be like, oh, I want to see price go up there. You have to understand, not me, not anyone else out there. You have to understand, what it is you want to see, why you want to see it. Why should anything you say happen? Why should any of your biases even, be close to being correct? If you can't answer that question, you shouldn't really be speculating, right? And the only way you can answer that question is if you put in the time required to actually understand and study market cycles and study. You don't even need to use ICT, right? If you don't like it, or you don't like the man or whatever, you don't have to use ICT. People, there are people who I would say have made money without ICT. The problem isn't the strategy, it's you, okay? You have to know what it is you're looking for, why it is you're looking for what you're looking for, and you want to know if you're going to act on what it is you're looking for if you do eventually see it, right? You don't want to just, You don't want to just let it go. You've been waiting for it. You got to do something, right? So that should conclude this video. Like I said, it shouldn't take a scientist to basically speculate that if the dollar is likely to go up, opposing things are likely to go down. So we might not even be seeing all-time highs in stocks for a very long time. Obviously, they will eventually go back to all-time highs. You always see people saying, oh, the AI bubble. AI is not a bubble. It's not AI. That's probably the most stupid thing I've ever heard. AI is not a bubble. And AI will continue to be more and more important. And while you be like, oh, AI is a bubble, the rich people are buying more stocks. As it goes down, they buy more. So you should think about that. If the people who have the most money are not selling and they're buying more, obviously that's not like an indicator of itself, but you should think about it. I mean, where are the rich people putting their money? Stocks. They've always put their money in stocks. The S&P hasn't had a bad year, at least not in 2008 and some other years. But, it's had more good years than bad years, right? Don't clip that out of context. Anyway, that's pretty much it. And I will see you next time. I don't want to yap your ears off. Yeah, GG's, toodles, whatever people say as goodbye where you're from. And I will see you in the next video.